Welcome back. Today we are talking big purchases and how the credit score could impact that. I know interest rates are incredibly low right now, so I'm going to bring in financial analyst Steve Budin to talk about why our credit score is so important and how often we should be checking that. Steve, good morning.
Good morning. So when you make a big purchase, albeit a home remodel, a house, a car, very often people borrow money, and the interest rate you pay is directly related to how good your credit score is. Institutions will lend you money with the expectation of you paying it back. So the better your credit rating, the lower the interest rate you're going to pay. So it is very important.
And we have a free credit check once a year, right? Should we be checking it much more than that?
Yeah, I think at a minimum, you'd like to check it once a year because it is free. But anytime you're going to make a big purchase, maybe a month or two before you plan to do it, do another credit check, because your credit report, I should say, does get updated fairly frequently. So the more accurate it is, the better it is for you. So the more often you check it, then you have the ability to correct mistakes. There are lots of mistakes that happen. I've seen it on mine a lot. And the quicker you address the mistakes, the easier it is to fix. So check it fairly frequently.
Let's talk about credit limits. Let's say I have a credit card with a limit of $5,000. How much realistically should I be putting on that credit card to where it won't be a detriment to my score?
That's a great question. In fact, I just learned this doing the research for the story. There's something called a utilization ratio. So traditionally, I would tell our viewers that if you have a $5,000 credit line and you have an outstanding balance of even $4,000, as long as you're making the minimum payments on time, it helps your credit score. But now they have something new with this utilization ratio that says if you have a $5,000 credit line, and let's say you're running a $4,000 balance, that's not necessarily that good because it shows your tendency to use credit. So if you have a $5,000 balance, the lower your ratio, maybe 1,000 or 2,000, that actually looks better. So the advice would be to, if you do have a once a month large purchase, make a mid-month payment on your credit. So this way it shows a lower ratio and it shows that you're not trying to or have a tendency to max out your credit cards.
Okay, and on a similar line here, really quickly, if we should be timing out our big purchases that we are putting on those credit cards.
Right. If you think that you're going to be buying a home in the next few months or buying a car, don't make any big purchases the month or two before that, because that will impact your credit score in the short run. So try to stagger out those long-term big purchases.
All right, getting our credit scores right before we make those big purchases. Thanks, Steve. We'll be posting more of this on our website, KTNV.com. We'll be right back after this.